The Japanification of America. One of y'all had sent me this article, which I want to go into because this is something I've been thinking about a lot, actually. And we're going to start by showing you what happened in Japan if you invested there in 1990 and forward. So this is part of my soon-to-be released book, Retire on the Wellington Fund. And I show you what happened, how bad it was in Japan with the sequence of return risk, low inflation, all that. But so here we go. We got Nikkei, which is essentially the Japanese version of the S&P 500. And you can see what happened 1990 through 1998. We had, 9 years, 6 years down, 3 years up. Not much inflation. In fact, we had deflation in 1 year and less than 1% inflation in 4 of those 9 years. So inflation wasn't an issue. It's just the significant sequence of return risk. So basically, if you invested, if you were taking 5,000 a year out adjusted for inflation, or 5% a year out adjusted for inflation, you ran out of money in 8 years. Not good. Not good. That's actually quite bad. So will that happen here? I don't know. But if we have a semblance of that, that does concern me because that's straight up ugly, man. That's straight up ugly. All right, so let's dive into this article. Actually, let me just share with you real quick. I also did if you did Japanese bonds. All right, so if you did Japanese bonds in 1990 and took 5% a year out adjusted for inflation, not only did you not run out of money in 8 years, you didn't run out of money until year 18. All right, I'm near 28, I should say. So I mean, look at this. So we have interest rates 6.96, and I'm just using the 10-year as a 1 year return, and we can argue about this till we're blue in the face. Essentially, if you had a bond, a 10-year bond, a 10-year government bond in 1990 was paying 6.96. Same bond is paying 6.34. You can see it's just gradually going down. Look at that, 6.96 all the way to 1.74 to 1.31, 1 point. You see what I'm saying? So less than 2. Now it's less than 1. Negative interest rates in 2016, and you ran out of money in 2017, even though you were taking money out for inflation, and even though you weren't getting stock-like returns, the bonds had your money lasting 28 years, from 1990 to 2017. That's 28 years with no risk because the bonds are government guaranteed, and that's a pretty significant. That's a difference right there. So the drawback is that the bonds aren't paying anything, but if inflation is low and the bonds aren't paying anything, or if there is no inflation, at least the bonds give you a return, where the market, the stock market, gives you nothing. I mean, look at that. All right, so let's go to this article. I'm not sure who had written this. The Japanification of America. All right, Japanification is the process of other countries' economies becoming like that. Japan. Flatline with little to no growth or inflation, and interest rates stuck at zero indefinitely. Yep. Because the monetary death spiral we've documented here, many countries around the world are undergoing the Japanification. With interest rates now stuck at zero for the long haul and the Fed focused on employment above all else, U.S. has completed the process. I go through 9 economic metrics to show you how the U.S. is walking out the pan. The simplest definition of Japanification is the process we already talked about that, specifically like becoming like the economy of Japan. So what characterized the Japanese economy? Anemic growth, persistently low inflation, interest rate perpetually close to zero, falling population and labor force growth rates, falling productivity, ever-increasing central bank assets, rising debt to GDP, and proliferating zombie companies. In other words, Japanification refers to countries around the world experiencing the same stagnation that Japan has suffered over the last 3 decades. It is a process of rapid debt accumulation followed by monetary easing, which shields the government from normal consequences of overspending. As interest rates approach zero, all sorts of market, economic, and social distortions manifest. These distortions expand economic inequality, weaken productivity, and we talked about that. All right, government debt and central bank assets. Ever since the global economy abandoned any and all monetary anchors, such as gold or Bretton Woods, governments have been free to spend liberally, while central banks cushion the consequences of overspending via monetary easing. Indeed, as I explained recently, excessive unproductive government spending is the real problem behind the ever-increasing national debt loads in many developed countries. It is a culprit behind slowing economic growth, I could not agree more, which explains why Europe has experienced lower growth in recent decades than the United States. This argument is corroborated by a study by 2 European economists, which finds an increase in government size by 10% is associated with a 1.5 to 1% lower annual growth rate. Take the case of Japan. Japanese government spending has vacillated between 35 to 45% of GDP since the mid-2000s. And the U.S. average federal government spending is about 20% of GDP, but total government spending, including state and local governments, has been closer to a third. In the recent years, it's trending higher. If 2011 study is true, which I completely agree, it's called crowding out, my friends. When the government spends, they're crowding out productive assets. So the government's saying, we need to keep GM in place. We need to keep them. We're going to take your dollars and basically finance them as a zombie company, which means there's other companies, be it in car manufacturing, anything else, that are not getting the capital they need. It's the Schumpeter calls it creative destruction. You're allowing a GM to collapse in order for some other company to rise from the ashes and take over that, which ultimately increases productivity. But if you're allowing zombie companies to maintain themselves, banks, auto manufacturers, whatnot, they can't. And so we're literally taking assets, good assets from productive individuals and entrepreneurships and companies, enterprises, and putting it to bad. Zombie companies. Could not agree more. Because it's politically easy to raise spending, but politically different to raise taxes, deficit spending has tended to rise over time. And this is what we find with the U.S. And here we go, man. We got the debt to GDP. All right. So this is yeah, this is what I've been saying for 2.5 years. Here's Japanese debt to GDP, well over 200%. Here's the U.S. now to well over 100%, and yet interest rates are nowhere to be seen. The post-2020 projections in the chart above are not much updated in light of the pandemic, which will undoubtedly result in higher debt to GDP. So everyone says we're going to have runaway inflation because of debt to GDP. Well, it ain't happened yet. It hasn't happened in Japan for a long time, and they've had debt to GDP levels significantly higher than anywhere else in the world for a long time. All right, so since quantitative easing is basically money printing in order to indirectly fund government spending, the question is often asked more and more, doesn't QE produce a rise in inflation? The best plain English explanation I've seen for why huge amounts of QE are not inflationary is in this YouTube video, less than 10 minutes. I'm going to have to watch that. All right, so I won't watch it now, but I'll put a link in the show notes. In this video, Eric explains why, in a deeply indebted economy, I'm looking for QE typically fails to produce additional growth, and why it instead mainly produces financial asset inflation. When an economy becomes over-leveraged, banks become more reluctant to incrementally lend, and borrowers more reluctant to incrementally borrow. And that's what my man Richard Coos in his book, I guess I put it back on the shelf, The Holy Grail of Monetary Economics. Just because you have low rates doesn't mean people are wanting to borrow. They're just not. So the central bank's printed money usually just sits on the bank's balance sheets, just sitting there. Someone going to borrow me? No, because people don't want to borrow. Economic growth, interest rates, and inflation. Here's Japan GDP growth. You can see, joops. And here's 10-year government bond rate, joops. As government spending, government debt, and central banks, it's almost like CO2 and temperature. What increases? Does CO2 lead to higher temperatures? Does higher temperatures lead to higher CO2? Stop with this. It's definitive. No, it's not. And same thing here. Government growth lead to lower government growth lead to lower 10-year bonds, or does higher government growth lead to higher 10-year bonds, or does lower 10-year bonds lead to lower government growth? What comes first? I would say it's lower government growth leads to lower 10-year yields on bonds, and you can see there's a correlation there for sure. And U.S. as well. So here's government growth in purple. I mean, it's bound all over the place, but you can see the what's the word I'm looking for? The curve, the trend line is going down. So we have a 10-year government bond up here at 8%, and now it's at less than 1%. And we have GDP that was at, I don't know what that is, about 6 or something like that. They should have a second thing. And now it's down at, well, it's not negative 0.34. It's flat this year. Weakening economic growth and rising debt levels do not result in higher interest rates. Could not agree more. Even if interest rates are going down. Even if interest rates from the 10-year bonds are going down, weakening economic growth and higher debt levels do not lead to higher interest rates, i.e. inflation. Consider a similar case of private company with weakening growth and a rising debt load. That natural market response would be, of course, higher interest rates. There are 3 reasons it doesn't happen with governments. fiat currencies, which allow government to print. Central bank printed money doesn't typically end up in the real economy. It just sits in the bank. The drag on economic growth corresponding to increase the drag on inflation, right? Because we're funding zombie companies who are not increasing productivity, and as such, it's hurting growth, not helping it. Core inflation has followed similar patterns. You can see here it was back there for U.S. Here it is for Japan. And just the trend line is going down. 1.74 in the good old U.S. of A to negative in the Japan. Population and growth right here. What is the oldest country by median? And it's Japan by far. Japan, Germany, Italy, Greece, Bulgaria, Portugal. Anything ring a bell there? Japan and all the rest of European countries. The combination of very long life expectancy and low birth rates has resulted in Japan having the greatest society on the planet. And many European countries have the same. How about the US of A? The median age was 38.2 in the US in 2018, but that number is set to rise closer to that of European countries as seniors are the fastest growing of our population. For 30 years, the population growth rate has fallen in fits and starts in Japan, dropping 60 basis points since 1990. Meanwhile, in the U.S., population growth peaked in 1993 in one last burst of fertility, then slumped in more or less the same pattern as that of Japan. So you can see we are growing at 1% and Japan is actually losing population. But this population growth isn't enough. We need, like, I think it's a 2 for every woman out there. You need to have 2 children in order to make a growing population. U.S. population is set to continue to fall. According to Census Bureau, annual growth averaged 2.3 million from 2010 to 2020 and was projected to be the same over the next 10 years. From 2030 to 40 is projected to be 1.8 million. From 2040 to 60, 1.5. The pre-pandemic forecast now looks optimistic in light of the economy virus. But moreover, the current presidential administration has taken steps to significantly curtail immigration, which will reduce population growth even further. Though slowing population growth has not delivered the same workforce stagnation experience in Japan. So Japan, because we've got the best, and we have a pretty liberal immigration, and we've got the best and brightest. So our population growth internally hasn't been the same as Japan, but certainly we've gotten the best from India, the best from Guatemala, the best from Asia, China, and whatnot to come here and start entrepreneurial gigs, which have helped spur our economy, which Japan denies. It will almost certainly slow along the slowing population growth going forward. The 7.5% total labor force growth from 2010 to 2019 is already lower than the 9.2% total growth from 2000 to 2009. What's more, there are 3 general ways in which higher government spending leads to lower population growth. Higher taxes. Second, the extent of government spending is not funded by tax; it's funded by debt financing. Modern monetary theorists will hastily point out there's a third option: money printing. So when the government relies on credit markets for a significant portion of its spending, less private savings remain available for productive investment. That's 100% right. Higher government spending tends to funnel welfare or entitlement programs, which tend to reduce the traditional economic incentive for having children, actually growing yourself instead just sit there and twiddle your thumbs. All right, we're done. I'll put the link in the show notes, but I absolutely think we're going to a Japanification of the U.S. and I think most. And China as well. I mean, they're already saying China is going to have 750 million people at the end of this century. So China is already on the way down in terms of population. Japan, Europe, U.S. The only population growth ones are Nigeria and I think Indonesia or something like that. Everybody else is just the population isn't growing. And of course, for the developed world, the debt levels are so high, the population is not growing. And on top of that, huge amounts of debt, which crowds out private financing. We're going that route, so be prepared. I will see you.